It feels good whenever you buy a stock that you've been wanting. And after years of watching and waiting, I was finally able to hit the buy button on a stock that I've been holding out for. And that stock is United Healthcare. Now, in today's Build, Invest, Live podcast, we're going to go through what happened with United Healthcare, my stock evaluation criteria, and how UNH matches up against it, and why I finally decided to buy now. So let's get into it. So there was this tweet last week that I really kind of enjoyed, and it was just perfect timing. And it was a tweet basically asking about the stock that got away. What was a stock that you wanted to buy at previous levels and you just never did, and it kept going up? And for me, there's actually two of them. One of them is Apple, which we'll talk about on a different show some other time. But the other was United Healthcare. So how happy was I when I got to respond back to that tweet basically saying, well, it was United Healthcare until this week, which is just pretty sweet. And not only did I get to buy in, but United Healthcare is now my largest individual stock holding in this dividend growth portfolio, which is just amazing. On June 20th, I bought 100 shares at, $458.15 per share, which the nice part about that is it's already jumped almost 5% since that entry. Not that it matters. For me, this is a long-term hold, and so what it does in a week is really irrelevant. But it's nice, when you purchase something and it pops up a little bit to give you some of that kind of baked-in cushion. Usually it's the other way, right? You buy and it goes down and you're like, what did I do? But in this case, it went up a little bit. I'm happy about it, but I'm mostly happy that I got into this position with this company that I've been waiting on for a long time. So let's break down how this happened, or what happened with United Healthcare, what I was looking at, and what finally made me take the jump and have the decision to buy now. So how did this happen? So the reason that I never bought United Healthcare in the past is that it had gone up so much that it just never really hit my valuation metrics, right? It would have some pullbacks, but they were relatively minor, and it would never have that big pullback to where the valuation metrics that I use would hit. And so I just kind of waited and waited and waited, and it really just kept going up. But on June 30th, their CEO was at an investor conference, and he gave a presentation where he basically said that their share of premiums spent on healthcare costs are rising. And let me kind of explain what that means in kind of normal English, right? What he's saying is that after the COVID years that have happened over the past couple years, people are now starting to get back to the more discretionary healthcare and operations that maybe they put off before because people were only dealing with the most critical things during COVID. So what that means for United Healthcare is they're going to have to provide that treatment, right? Provide those operations and spend more of the money that they bring in on premiums to actually deliver healthcare. So their costs in general are going to go up. So that, caused the stock to drop almost 8% in that initial trading day, which is quite a bit. And that's when I started getting interested in it once I heard the news and I saw that the market was kind of, what I consider to be overreacting. And I was like, yeah, let me dig into this and see if now it's finally going to hit my valuation metrics, right? So I spent part of that weekend re-looking at United Healthcare. So I guess number one, I'm a little proud of myself that I didn't just immediately buy because, I think like everybody, I have a tendency to get excited when I see something that I'm interested in go on sale. But in this case, I actually waited a couple of days for it to kind of mellow out a little bit, for the market to consolidate a little bit. And I spent that weekend, specifically that Saturday after the drop, reevaluating United Healthcare. So here's what I found, and here's what made me buy. So first of all, if you guys remember, the criteria that I look for in a dividend growth stock kind of breaks down like this, and this is what I use in my spreadsheet. Number one, I want companies that are cash flow rich, ideally with a price to free cash flow less than 10, or a cash flow yield that's greater than 10%, which is basically the same thing. It's the same number, just inverted. I want companies that have a return on equity greater than 20%, which speaks to the efficiency of how well they're able to generate a return. I want to see a reasonable dividend payout ratio, which for me basically means anything under 50, but the lower the better. I want to see dividend growth that is higher than inflation. In my spreadsheet, I use 8% or higher. Obviously, inflation isn't usually 8%, that's high. But I'm looking at a number that if it's 8% or above, then that is a really good dividend growth rate. And to me, that's ideal. So that's what I use. I want to see at least 10 consecutive years of dividend increases. Now, again, these things are just a guide, but I just use that as 10. If they've done it 10 years in a row, that's pretty good. If they've done it more, even better. If they haven't, then again, it's just a thing that I'll dig into and try to understand why. I want to see the dilution trend to be down. So basically shares outstanding, I want to see that, on a downward trend. What that means is that they're not diluting their shares and diluting my interest in their company by issuing new shares. And if they're actively buying back shares, it means that they're using additional capital in the business, not only for dividends, but also to increase my percentage share in the business. And so when you find a company that issues dividends at a good growth rate and buys back shares, that's a very good thing for investors. In terms of moat, I prefer them to have a wide moat. This is based on the Morningstar moat rating, but a great narrow moat company is okay as well. If they have no moat, I'm usually not interested in those stocks, but it's still on a case-by-case basis. But wide moat, absolutely. Narrow moat is okay as long as everything else checks out. And then lastly, I want to see that they've outperformed the S&P 500 on some reasonable timeline before. And I've talked about this in previous videos, but my whole thought process here is that if all the measurements look good for this company and they've never outperformed the S&P 500, then my question would be, what is different this time that's never happened before that will cause them to outperform? And if they're not going to outperform, then there's no point in me buying the stock. I might as well just buy, an S&P 500 index fund and get a better return. But that's kind of where that is. And so those are my criteria that I use. So the question now is, how does United Healthcare match up? So after the drop, when I looked at UNH again, things started to look really interesting, actually. And if you look at the cash flow yield and the price to cash flow, we're going to get back to that in a minute. But when I looked at return on equity, it's obviously over 20%, so that's good. Payout ratio is under 30%. That's good. When you look at the dividend growth rates, they are, the only word to use is excellent. The 10 years over 20. The lowest out of the 10, the 5, and the 3 is a 3-year at 15%, which is excellent. It's almost double kind of my ideal number. So very good. So years of dividend increase is 13. That's good. The dilution trend of their shares outstanding, is down. They have a narrow moat, which again is fine. And when you look at the performance that they've had, it's just been astronomical, right? And again, I have to reiterate this every time. Past performance is not an indicator of future gains, but the reason why I use it is because I want to know, have they ever outperformed the S&P 500? And the answer for United Healthcare is not only have they outperformed, they have completely crushed and demolished the S&P 500 over the last 10, 20, and 30 years. Now, that doesn't mean that they're going to do it over the next 10, but it at least lets me know that this is a company that has shown to be a very good investment. And so if I'm getting it at a good valuation and I still believe in who they are and what they do, then it might be a good time. So the only question mark that United Health really had was the price to cash flow ratio. It was at about 12, 13, a little over 13, and ideally I'd like it to be under 10. Now, I just have to reiterate, these criteria are just a guide, right? Like, it's not a checklist where you say, hey, this stock met every single thing and it's only based on these numbers and you just blindly buy. Like, the reason why I use it is because I want businesses that are generating cash, are efficient at doing it, they pay dividends at a good clip that beats inflation, and they've been able to beat the S&P in terms of total return, right? And if I get companies that can do that, and I believe in what they're doing in terms of their outlook, their products, their management, their industry, then all those things make sense and come into a decision to buy. It's not just about these numbers, but they're a good guide to kind of make sure that I'm only looking at businesses that kind of meet this criteria that I think is important. Hopefully that makes sense. But since the price to free cash flow was really the only question mark that I had, I decided that I was going to do a little bit of digging to find out if it was a concern or not. Now, how I use price to free cash flow is one, it tells me if a business is generating cash. And I've talked about in the past that I don't really like to use earnings because earnings can be manipulated with accounting tricks a little more easily than cash flow can. And cash flow is the actual money that you're putting in your bank account based on your business operations. And how price to cash flow ratio is used is it just helps you understand if a business might be undervalued based on the amount of cash that it's actually generating. So I decided to go take a look on macro trends of what United Healthcare's price to free cash flow ratio was over a longer period of time. Now, I just released a video this week that included 5 free tools that I use to evaluate stocks. It included macro trends and a few others. So if you're interested in learning more about that, I'll put the link down in the description so you can understand how I use macro trends specifically, but then also the other free tools that I use to evaluate stocks. So I go to macro trends and I go to United Health, price ratios, price to free cash flow ratio, and it shows me the history of the price to free cash flow ratio for United Health. I'm just trying to get an idea of kind of where is it at historically in terms of price to free cash flow and what the stock has done in the past whenever it's kind of hit this price to free cash flow level. So if I look where it's at today, it's a little bit over 13, which is exactly what we had in our spreadsheet. And if I look, the last time that it really got to that level was in June of 2020. Now that was right in the, heat of COVID. And so I don't know that that number is a real reliable one in terms of, using as a data point. So I want to go back even further. So the next time it was under 14 was in September of 2017. Now that was a full 6 years ago when the stock was at 180. So over the past 6 years, it's went from 180 all the way up to over 500 to now, in the high 400s. So it's been on an incredible run ever since it was at last 13. And even if I look at the COVID year, in June of 2020, it was at $282 a share. So even then, it almost doubled just from that, data point in 2020, which has, only been about 3 years. And if I go back a little further just to see, now we get into a territory where it was kind of hanging around that mid double digit price to free cash flow. But again, we're getting into 2015, 2016. That's a good 8-9 years, in the past. So it's really hard to gauge how much of that is still relevant in terms of overall price action for United Health. But what this tells me is that the price to free cash flow ratio, a little bit above 13, in general looks to be a pretty decent buying area for United Health based on the last 10 years or so. And that's really what I wanted to get an idea of is, okay, price to free cash flow may not be exactly meeting my criteria of being under 10, but in terms of the history of United Health, it looks like it's at a level that presents a buying opportunity. So that's a really great example of how I use macro trends and what I use it for and how it can kind of help shape my buying or selling decisions when it comes to these stocks. So in terms of the concerns that were raised by the CEO, for me, I see that as a quality company just being, honest and transparent about what's ahead of them. It's not something that I'm overly concerned about. United Health has such a long history of top-notch performance as a company and as a stock. So I look at this dip as just a kind of momentary opportunity to buy and not something that I'm worried about over the long term. And, even though it didn't exactly meet my stock criteria to the T, when I looked at that historical price to free cash flow ratio, it looked like for this company, it's at a attractive buying level. So I bought. And, now it's actually the largest position that I have in my dividend growth portfolio. So I'm definitely excited. And I feel good about those shares and what they're going to do over the long term. Again, this isn't something that I'm going to look at in 6 months and be either overjoyed or disappointed. This is something that I'm truly planning to hold for a very long time. But as with anything as it relates to stocks and investing, only time will tell. Oh, and if you notice these Walmart shares in my portfolio that you hadn't seen before, that's because I just bought those. And I actually broke all of my own criteria rules when I did so. But that'll be the topic for next week's episode. So if you're interested, make sure you're following the show so you don't miss it. Now, I'm super excited to finally be owning United Health. And if, Apple would just go ahead and dump 20%, we'd be all good. So your move, Tim Cook. Thanks for listening to this episode of the Build, Invest, Live podcast. Financial independence is true freedom. Keep building and stacking those wins. And I'll see you guys on the next one. Peace.